What's going on, guys? Good afternoon. Good afternoon. Let me see how I can do this in the best way possible.
Everyone, once again, please welcome past chair of the club, Deborah Cafaro.
From around the country are a testament to the importance and the timeliness of today's topics and speaker.
Why is it so goddamn loud?
Today, we have the greetings. I want to warmly welcome you to today's Economic Club of Chicago program. The overflow group that we have here in the room in Chicago and the countless others joining us virtually from around the country are a testament to Please remain seated and quiet during the program so that we all can gain the full benefit of Chair Powell's remarks. And now it's my pleasure to welcome my friend Austin Goolsbee, the President and CEO of the Federal Reserve Bank of Chicago, a renowned economist and our fellow ECC.
What is wrong with these people? It's way too loud.
And now it's my pleasure to welcome my friend Austin Goolsbee, the President and CEO of the Federal Reserve Bank of Chicago, a renowned economist and our fellow ECC member. Austin, take it away.
Thanks, Debbie. It is a real pleasure and delight. Should I move that for you? To introduce our guests, two of the firmament of economics and finance. First, let me introduce the moderator, my friend and 40. He's since over age 40, but he was the inaugural winner. He is a member of the group of 30, and he was the 23rd governor of the Reserve Bank of India, and before that, chief economist and director of research at the International Monetary Fund. You probably know him as a regular contributor to the Financial Times. He speaks extensively on...
All right, I'm going to wait until Jerome Powell's on. I can't take that microphone noise, and I'm sure you guys can't either. This right here is NQ. You could tell what I'm looking at because it's right there. Up your volume? I think it's fine. Honestly, I think it's fine. I'm quiet? Let me see. Oh, it's good? All right, let's see there. Hopefully that's better. I'm going to try to turn up the gain. All right. So I tried earlier once we broke this market structure here and retested, I actually took a long with micros, but then I noticed something on NQ. This right here is a low resistance liquidity. And this is a low resistance liquidity run. So you could think of, even though it's not the classic consolidation manipulation, this is the consolidation. We're just consolidating down, right? And then we manipulated up and then came down to take out all of these lows. If you look at the high time frame, we had a bunch of lows right there. So we came down to take that out. So what I'm looking for here is I want to see if there is a chance for us to go long. You can see that right there's a 15-minute fair value gap. And if we look at ES, we're pretty far away from that. I believe that's the same 11:45 from Friday. All right, let's see.
And thanks for that kind introduction, Austin. So I'm looking forward to my conversation with Professor Raghu. But first, I'll briefly discuss the outlook for the economy and monetary policy. So, at the Fed, we are always focused on the dual mandate goals that Congress has given us: maximum employment and stable prices. Despite heightened uncertainty,
I'm looking for potential longs today, by the way.
Still in a solid position. The labor market is at or near maximum employment. Inflation has come down a great deal, but is still running a bit above our 2% objective. Turning briefly to the incoming data, we'll get the initial reading on first quarter GDP in a couple of weeks. The data we have in hand so far suggests that growth has slowed in the first quarter of this year from last year's solid pace. Despite strong motor vehicle sales, overall consumer spending appears to have grown modestly. In addition, strong imports during the first quarter, reflecting attempts by businesses to get ahead of potential tariffs, are expected to weigh on GDP growth. Surveys of households and businesses report a sharp decline in sentiment and elevated uncertainty about the outlook, largely reflecting trade policy concerns. Outside forecasts for the full year are coming down, and for the most part point to continued slowing but still positive growth. We are closely tracking incoming data as households and businesses continue to digest these developments. In the labor market, during the first 3 months of this year, non-farm payrolls grew by an average of 150,000 jobs per month. While job growth has slowed relative to last year, the combination of low layoffs and lower labor force growth has kept the unemployment rate in a low and stable range. Meanwhile, the ratio of job openings to unemployed job seekers has remained just above 1, near its pre-pandemic level. Wage growth has continued to moderate while still outpacing inflation. Overall, the labor market appears to be in solid condition and broadly in balance, and is not a significant source of inflationary pressure. As for our price stability mandate, inflation has significantly eased from its pandemic highs of mid-2022 without the kind of painful rise in unemployment that has frequently accompanied efforts to bring down high inflation. Progress on inflation continues at a gradual pace, and recent readings remain above our 2% objective. Estimates based on the most recent data from last week show that total headline PCE prices rose 2.3% over the 12 months ending in March, and that excluding the volatile food and energy categories, core prices rose 2.6%. Looking forward, the new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. These policies are still evolving, and their effects on the economy remain highly uncertain. As we learn more, we will continue to update our assessment. The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth. Both survey and market-based measures of near-term inflation expectations have moved up significantly, with survey participants pointing to tariffs. Survey measures of longer-term inflation expectations, for the most part, appear to remain well anchored as well. Market-based break-evens continue to run close to 2%. So, as we gain a better understanding of the policy changes, we'll have a better sense of the implications for the economy and hence for monetary policy. Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. As that great Chicagoan Ferris Bueller once noted, life moves pretty fast. For the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance. We continue to analyze the incoming data, the evolving outlook, and the balance of risks. We understand that elevated levels of unemployment or inflation can be damaging and painful for communities, families, and businesses. We will continue to do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to our discussion.
Thank you very much, Chair Powell, for those remarks. I look forward to your elaborating on them in the course of the next 40 minutes or so. I understand last time you were here, Melody Hobson interviewed you. Well, I'm a poor substitute, but I'll try and compensate in the quality of the questions. As you repeatedly emphasized, communication and transparency are very important for the Fed. I would like to get more from you on some of what you just said. As a former central banker, the only sort of caution I've been given by the Economic Club is to not lapse into central bank speak. So I'll try my best not to do that. Let me start by saying you've guided the Fed through some really difficult events, including the pandemic, the dash for cash in March 2020, the great inflation, the banking crisis centered around Silicon Valley Bank. And then over the course of the last year, we've seen a growing possibility of a Fed-engineered soft landing. And now, it seems like everything has changed. In the course of a couple of months, JP Morgan has shifted to estimating the probability of a recession this year at around 60%. What do you think about all this?
Well, first of all, thank you for being here today. It's a pleasure to be here with you. Actually, the appearance I did here was my very first appearance as chair 7.5 years ago, so it's great to be back. And I would agree with you that it's been an eventful 7 years. Putting it mildly, I keep waiting for the 3 months of calm, that never comes. But to your question, I guess to set the stage, let's look back at 2024. 2024 was a year where the economy grew 2.4%. Unemployment remained in the low 4s, close to mainstream estimates of maximum employment, and inflation came down and was running at the end of the year around 2.5%. That's the economy that we had, and I won't decide how to characterize that, but that was That's where things were. Where we are now, again, to your question, is the administration is, as I mentioned in my remarks, is implementing significant policy changes, and particularly trade now is the focus. And the effects of that are likely to move us away from our goals. So unemployment is likely to go up as the economy slows in all likelihood, and inflation is likely to go up as tariffs find their way, and some part of those tariffs come to be paid by the public. So that's the strong likelihood, and my hope is that we'll get through this and get back. Well, we're always going to be aiming for maximum employment and price stability. That's what we do. I do think we'll be moving away from those goals probably for the balance of this year, and then, or at least not making any progress, and then we'll resume that progress as we can.
Let's talk a little more about tariffs. I mean, you recognize that some of the effects of the tariffs will be one-off, transitory, but you also have said that perhaps they will give room for a number of firms to raise prices. You mentioned dryers. When washing machine prices went up because of tariffs, dryer prices also went up in tandem, even though they weren't tariffed. What's your sense about the effects of tariffs on inflation? What would make them more persistent, and what would make them have effects on growth?
So in a kind of a simple starting point is one tariff comes in that gets passed along in prices and raises inflation, but it's just a one-time thing. So the price level goes up, and that's it. But that can happen in some circumstances, but it depends on a number of things which we don't know yet. And I would point to a couple of them, or three of them actually. One is just the size of the effects. And as I mentioned, the tariffs are larger than forecasters had expected, certainly larger than we expected, even in our upside case. We looked at a range of cases. So that's one. The second one is how long does it take for the tariffs to have their effects on inflation? To the extent it takes longer and longer, that raises the risks that the public will begin to experience higher inflation. They'll come to expect it, and companies will come to expect it. So that risks higher inflation. And the third is just what I mentioned in my speech, which is my remarks, which is got to keep inflation expectations well anchored. So if we have those three things under control, that's what it will take. And indeed, our role is to make sure that this will be a one-time increase in prices and not something that turns into an ongoing inflation process. That's a big part of our job.
What about the effects of tariffs on quantities? With the level of tariffs that, for example, have been currently applied on China, there's a fear that the supply chain may get disrupted, that firms may not be able to import their relevant stuff from China given the level of prices. If it turns into a supply shock, would the Fed's response be different than if it was primarily something which affected just prices?
So I actually had dinner at the Chicago Fed last night, and with a number of directors of various parts of the Chicago Fed, and many of them are CEOs of significant companies, and they this uncertainty that they're feeling and the issue with imported components to their products is just a huge issue. But with
guys, I'm going to go through technical analysis, give you my update on the markets. So I'm just waiting for him to stop talking, but he's talking about tariffs and inflation. So obviously his words mean a lot to the market. So I just want to hear what he has to say, but I will jump into the charts and give you my take.
Of inflation. So when you think about supply disruptions, that is the kind of thing that can take time to resolve, and it can lead what would have been a one-time inflation shock to be extended, perhaps more persistent, and we would worry about that. In this case, you can look at the car companies, which their supply chains are likely seem to be on track to be disrupted significantly, and you would worry that process will take some years and that the inflationary process might be extended. So these are all of this is highly uncertain. We're thinking now, really before the tariffs have their effects, as how they might affect the economy, and that's why we're waiting really to see what the policies ultimately are, and then we can make a better assessment of what the economic effects will be.
Let's move to immigration. You talked about the labor markets being in reasonable equilibrium right now. Of course, what we've seen over the last few months, months of the previous administration continuing into this administration, is immigration has fallen off considerably. What's your sense on how that will affect the labor market?
So part of why growth was so strong in the last couple of years was just very high levels of immigration, and those people went to work. The economy hired them. You know, there was a lot of demand. We were still working on.
All right. So, there are a few areas of liquidity below, right? We obviously have this low here from last week. This is Friday's low. Whoops. This right here is Friday's low. ES, this is NQ. By the way, if you want to know what I'm looking at, there's the watermark here, and then there's the ticker symbol here. So what I'm looking at is one for NQ to target this area down here, right? And for ES, I would like ES not to take that area, but to fall into this 15-minute fair value gap, because that would then create a potential SMT divergence. Now, it's important to note, I want you to look at one thing and recognize the character here. This right here was Sunday's high, right? We took Sunday's high on Monday, and then made a lower high on Tuesday, made a lower high on Wednesday today. And then tomorrow is actually the last day of the week because Friday's Good Friday. And so that sets up, like when you typically see lower highs, right? Starting on Monday, you typically see lower highs. What that sets up is a potential rally on Friday, right, to run that low resistance liquidity. So that happens on the high time frame as well as the low time frame. So just like I was saying that earlier, I actually mistook this for a break of structure and a retracement into a fair value gap to go long. In essence, this was a low resistance liquidity, and then you end up engineering liquidity to run it, right? So I do think that tomorrow there's a possibility that this on the 1 hour time frame, all of this liquidity here gets ran. So what I'm looking for today, and I don't know if I don't think today we'll see a full-on reversal. No way. But what I'm looking for today is to see if ES can take at least this 15-minute fair value gap, while NQ can sweep this low from last Friday. This is last Friday's low right here. And if that's the case, then I think there's a thesis for a potential up move on Friday, right? Since all we did was sweep Sunday's high, and then since then made lower highs. Now, on the bigger time frame, I posted this in the Discord. On the bigger time frame, this is actually quite scary to me, because as I told you, if you guys watch my videos, as I told you with SPY, my first target is the previous high of 2021, right? And if you look at this here, that's 2021 high, and look at where we stopped before we bounced. However, if you look at how this looks, if you guys are familiar with a market maker sell model, right? You typically have consolidation, and then you have a rally, sweep of liquidity, and then a full-on reversal back to where that consolidation was, right? And we have that consolidation here. It almost looks like a head and shoulders, but it's not, okay? You have this consolidation here. You have a run-up, and then a continuation down back to that area of consolidation. So that can honestly put the S&P 500 at around 4,500. Now, I'd be a heavy buyer of the S&P 500. This is idiot talking about. I'd be a heavy buyer of the S&P 500 at that 4,500 for sure. Not only because it will complete the market maker sell model, but if you look at the S&P 500 earnings, it'll be back to reality, right? We were trading at a premium for a while, which is fine, but when we have these sort of crashes or bear markets, we tend to revert back to the mean. So about like an 18 PE for the S&P 500. So that's where I would be looking at, right? This low here from October 23, somewhere around there eventually. It might take a while to get there, to be honest. And same thing for NQ. NQ's at around 15.6 right here, right? So that is my longer term outlook, but obviously not for today. Right now, I just want to see us take out Friday's low on NQ, and I want to see ES not take out Friday's low. That would give us a bullish divergence for potentially a play tomorrow. And you can see what I was talking about here, the market maker sell model. You can see it on the lower time frame, right? I showed it to you on the daily. This right here is the 5-minute. You have all this consolidation, and then you have basically this curve back to that area of consolidation. So I would like it if ES, either ES stops here at the 15-minute fair value gap, or ES takes this out while NQ takes out an even lower low, like Thursday's low as opposed to Friday's low. So that's what I'm looking at right now. Yeah, sorry, I keep saying Friday. I mean Thursday is the last day of the market this week because of Good Friday. Any thoughts on a lost decade type scenario? It depends on how long this is dragged out. So I always thought that we were in a recessionary risk, and that was even before these tariffs. But I think obviously the recessionary risk is even higher now. And I think that's actually what they want, is to engineer a recession in order to lower yields, right? And lower the treasury yield and the interest payment of the government. So right now, obviously, there's no trade on the indices. I'm just looking to see at what point this, at what liquidity level we're going to sweep here. They want to engineer a recession because Powell will be too stubborn? No. They want to, I feel the government itself, Bessent and Trump, have talked about a reset, a detox numerous times. I think it's hand in hand, because what we learned last week, which is something that I think is unusual, is that the Treasury Secretary Bessent and the Fed have breakfast every week. That's what Bessent said a few days ago. So
I would just say the same thing. I think it's very hard to know in real time. I've had a lot of experience with significant moves, for example, in the bond market, where there's a narrative that people land on, and then 2 months later you look back and go, that was completely wrong. So I think it's very premature to say exactly what's going on. Clearly, there's some delevering going on among hedge funds in levered trades and things like that. It's also, again, it's the markets processing historically unique developments, and with great uncertainty. And I think you'll probably see continued volatility. But I wouldn't try to be definitive about exactly what's causing that. I would just say markets are orderly and they're functioning kind of as you would expect them to in this time of high uncertainty.
So the Fed, in its last meeting, slowed the pace of shrinking of its balance sheet. Was this driven by uncertainty about how much reserves and liquidity the market needed, and you wanted to take a little more time to find that out? And flip side, you said the market was orderly. What if market disruptions emerge? Would the Fed intervene?
So we think that reserves are still abundant. So we don't think we're close to the point, particularly close to the point where we would stop. But we were facing a situation in which, for other reasons, there were going to be big flows into and out of reserves as it had to do with the debt ceiling and the Treasury General account. For those of you who are Treasury market people, that'll make sense. But while those big flows are happening for over a period of 6 months, we would actually be shielded from being able to see evidence that we were or were not getting close to the level of less abundant reserves. And so we decided to slow the pace. We thought about pausing, and instead we debated. It was one of these great debates that we have at the FOMC. We decided to slow the pace instead. And people really came to see the merits of that because, the slower we go, the less, the smaller the balance sheet can get without disruptions. And we want that process to continue, and now it's at quite a slow pace. So we think that's a really good thing. So that means it can go on for a longer amount of time, and we'll be able to reach kind of very carefully what we think is the right level of reserves. Still plenty of reserves.
What about the international dollar-based system?
Yeah, bonds are bouncing very nicely here. I actually took a position in TMF. I spoke about this in my video that I dropped on Sunday. You can go back and watch it. But I was saying that bonds will likely have a nice bounce from here. So TLT, TMF, both up pretty nice today. And you could see that the 10-year is finally dropping once again, going from 459 to 427. So about 32 basis points down so far.
That, and it supports dollar funding markets. Dollar funding markets are very sensitive during times of crisis, and it's very helpful. The reason we do it is it's really good for U.S. Consumers. So we'll continue to do that, just as part of the dollar being a reserve currency, the reserve currency, most important, and we will do that.
You mentioned amongst the issues you were focused on was the U.S. fiscal situation. Well, clearly, U.S. sovereign debt continues to rise. And what are your thoughts on the longer-term implications for interest rates and economic stability? How much further can we go in terms of national debt before we cross a line that might be unsustainable in the long term?
So the U.S. federal debt is on an unsustainable path. It's not at an unsustainable level. And no one really knows how much further we can go. Other countries over time have gone much farther, but we're now, we're running very large deficits at full employment. And this is a situation that we very much need to address. Sooner or later we'll have to, and sooner is better than later. In terms of, if I can say from my time working on these issues, it's not the Fed's issue, but if you look at a pie chart of federal spending, the biggest parts and the parts that are growing are Medicare, Medicaid, Social Security, and now interest payments. And so that's really where the work has to be done. And those are issues that can only be touched on a bipartisan basis. Neither party can figure out what to do without both parties being at the table. So that's critical. All of this domestic discretionary spending, which is essentially where 100% of the conversation is small as a percentage of federal spending and is declining it's already declining as a percentage of federal spending. So when people are focusing on cutting domestic spending, they're not actually working on the problem. Domestic discretionary spending is already going down. I like to make that point because so much of the dialogue that the politicians offer is about domestic discretionary spending, which is not the issue.
Well, let's turn to stability and regulation. Turning to the U.S. financial sector, we still have some concerns about distressed commercial real estate loans on bank balance sheets, whether they've been fully dealt with so far. There's some sense that they haven't. Add to that the very rapid growth in various forms of private credit over the last few years, which arguably haven't been tested by a full-blown recession. How would you put the resilience of our financial institutions at this point and their ability to weather potentially uncertain times?
So I think our banking system is well capitalized with liquidity and is quite resilient right now to the kinds of shocks that it may face. I do believe that. In terms of the commercial real estate, there are, and this has been the case, really we've been working on this for 4 or 5 years now. There are some banks, it's mostly medium and small sized banks who have elevated concentrations of commercial real estate, some of it troubled, and we've been working to make sure that those banks have a plan, have capital, and can absorb the losses that they're doing. So, and that's been going on for some time. The very largest banks don't tend to have high concentrations, so this is a problem that we have known would take years to work through, but we're really well into the process of working through it. In terms of the non-bank financial sector, it's grown enormously. The provision of credit by non-banks has grown just really fast. Most of it has been funded, though, with a private equity-like structure where it's limited partners who are signed up for 10 years to a general partner to invest that money. They're not depositors who can run. You know, your money's committed. And so that funding model is kind of run-proof. That isn't some law of nature, though. So when you do start to see shorter-term funding creeping in, to your point, though, Raghu, this very fast-growing and now quite large private credit part of the economy has not really been through a significant credit event or significant. It's really grown since the pandemic, and so just for that reason and for how fast it's growing, we have a close eye on it. It doesn't have the same kind of prudential regulation, though, that the banking system has. So we're watching it carefully. And, you know, as I mentioned, it's a more stable funding source to the extent its institutional investors signed up for a long period. But we're watching carefully.
Right. Wearing my banking research hat, actually banks are also involved in funding these institutions in a big way. Yeah. We do know the administration wants to relax regulations in many areas, one of which may well be banking. What can you tell us about the Basel III endgame, so to speak, which is, you know, at this point primarily focused on additional capital for the large banks?
You know, the Fed view, and my view, is that we should proceed to complete the Basel III accord, and we would have to do that, and would look forward to doing that in conjunction with the FDIC and the OCC. But our view is, and I think the bank's view as well, is we should complete that. You need international minimum standards. That's kind of a common good, and you know, we're not bound by them. Really, nothing. The United States has plenty of input into what those accords contain. So our view is strongly that we should complete those, and we could do it, I think, relatively quickly. We're not so very far away from what would be a good, I think, outcome.
Well, let me move to something which is more about technological change and new kinds of instruments, cryptocurrencies. How do you see the potential for more favorable regulations coming on them, and potential risks from that for the system?
You know, so we went through a wave of failures and fraud and things like that were the headlines for a couple of years, and I think what you see now is, and during that period, by the way, we worked with Congress to try to get a legal framework for stable coins, which would have been a nice place to start. We were not successful. I think that the climate is changing, and you're moving into sort of more mainstreaming of that whole sector. So Congress is again looking at both the Senate and the House are looking at a legal framework for stable coins. You know, depending on what's in it, that's a good idea. We need that. There isn't one now. And stable coins are a digital product that could actually have fairly wide appeal and should contain consumer protections of the typical sorts and transparency. And that's what the Senate and the House are working on. So that's a positive thing. I also think some of the, we took a pretty conservative, and other bank regulators took an even more conservative perspective on the guidance and rules we imposed on banks. I think there'll be some loosening of that, and I think we'll try to do it in a way that preserves safety and soundness, but that permits and fosters appropriate innovation, but that does so in a way that again doesn't put consumers at risk in ways they don't understand or make banks less safe and sound.
You have a policy review underway. Now, surveys recently tell us there seems to be a distinction between a rise in the level of prices, which is what the public seems to worry a lot about, and the rate of increase in prices, which certainly they worry about in passing, but the Fed worries much more about. That is the rate of inflation. So even though we're coming down to 2%, people remember that over the last few years, it's been over 20% increase in prices. So as you start thinking about the policy review, is there any thought about how you might want to address this sort of challenge, that it's the path of prices as much as the rate of change which matters?
First of all, I think you're right, and I think the public is right. When we say inflation is back down to 2%, 2.5%, and we think that's a good thing, it is a good thing. But if you're paying 20% more than you were paying in 2021, that doesn't help you much. You're still paying a lot more than you used to be paying for the necessities of life. So it's just another way of saying people hate inflation, and it's easy to understand why. All we can really control is a world in which, in the world we're living in, prices don't go down in the aggregate except in extreme times that we don't want to court. So I don't think we couldn't have a framework where we're going to bring prices down by 10% or something. That's not something we'll be looking at. We're essentially looking at the best way to foster 2% inflation over time. And the things we did back in the changes we made in 2020 were really innovations around what to do when you're stuck near zero. Now we're well above zero, and it may be that we still need to have in our framework a way to deal with that, but perhaps the main case is not one where you're dealing with the effective lower bound, and that would be a framework that looks a lot more like the one that we had before 2020.
Now, one of the tools you brought in to deal with the zero lower bound was quantitative easing. But you've also used quantitative easing to fix disruptions in the financial markets. Are you going to be more specific about what your objective is with quantitative easing as you go through this review?
So in the beginning, it's typically we're using it for financial market function. That was the case with the global financial crisis and with the pandemic. And we did try to explain ourselves through the pandemic, and our explanations did change. But I think it's fair to say we might have done a better job of.
So, twice I was stopped for break even, but I like a short here down to that low that I was talking about. Could have booked it twice for 700 per contract, but I like a short to get down to that low that I was talking about. It just keeps consolidating in here, and because of we're shorting at the lows. For me, I have to manage my risk properly, and that includes putting my stop to break even when it's up by a lot. But we keep consolidating, coming back up and taking my stop. I could close, obviously just scalp this, which is probably what I'm going to do from here on out, is just scalp these moves because it's an easier reaction to read. And it is resulting in, $700 per contract each time that I take the scalp. I just put the stop to break even because I want a much bigger move, which is down to that low. So that's essentially what I'm looking at right now, right? Is a play to that draw down there. So Michael says boring. Not as boring as your mother, which is why I'm here entertaining you. She's in the other room, and I'm really supposed to be courting her, but I can't stand her. So yeah, I think we get to that low on NQ 18270.5. And I think that if you're trading options here, you're getting smoked, because not only are options super expensive, especially puts when the market has dropped 3%, but you're also, this type of chop in options is going to kill you, whereas in futures it works pretty well. So I ended up taking this in my prop. I'm trying to trade it to get down to that 18270.50. And if this comes back and hits me for break even, then I'm going to just scalp in this range, because the scalps are really easy for me here. Like we're reacting off of this exact level multiple times, and it's resulting in, quite a few gains. But they're only scalps. Now that we close below that fair value gap, I think we can go down to 18270. Let's see. Hell yeah. Let's go. Let's get to 18270. That'll be almost $2,000 per contract. You saw my clone in Vegas? Impossible. How many of you guys are in this? How many of you guys are in NQ short here? For those of you in the Discord, I know that you guys are on it because you guys already know what's up. But for those that aren't, I wonder, can we get to 18270.50? What is ES doing? We got to check up on ES. Okay, I'm setting my stop to break even here. Look, in all honesty, guys, this right here is a 2-to-1. So you can book it. But the drawn liquidity is right there, which is almost 3-to-1. MP3 Fitness, thank you for your donation. I saw Serrano donated earlier as well, too, and someone else I missed. I apologize. Who did I miss? Someone else donated. I know. There was Serrano. Appreciate your donation. MP3 Fitness and someone else. See, guys, like my... Too choppy for shorts? Bro, you can book thousands of dollars in this range. It looks small. This is $100 range here. T Black. There you go. Appreciate it, T Black. What is this fool yapping about?
Fed independence is very widely understood and supported.
Surf, appreciate your donation. Are you in this, Surf? Or did you close it already? This is a very small range, guys. If we weren't shorting in the absolute bottom of the discount, I would totally take another contract here. I would totally add another contract here. But I have to manage my risk. Like I usually like to add to winners until the draw on liquidity is hit. But I can't add a contract here. Oscar, thank you, man.
Chicago. Thank you, Chair Powell and Don, for such a wonderful conversation. You are a national treasure, and I hope all of us can see how important Chair Powell's role is in our business and personal life.
All right, well, they're done talking. All right. That's the third time I break even. So playing for a bigger move. This is so funny. 3 times I could have booked it for over 700 per contract. Hindsight is 2020, right? But I wanted to play for this 100-point move. But it's so funny because the 100-point move is $2,000 per contract, and 3 $700 moves is the same. Four-time lucky. Now that they're done talking, what I want to see is a run of where the liquidity is, right? I want to see. Oh, ES took out these highs. Let me see one thing. But because the event is over, like right this second, we could get a run of liquidity before an actual move. So let's see. It could, yeah, for sure. I mean, that's OTE right there. That's an area of rejection. We took out that liquidity there. And then I'll go over some equities. Am I gonna re-enter this? No. No, I'll wait to see if we get a close below this IFVG. After sweeping these internal highs, this is OTE, like it is low risk. You can take it, but I think at this point it's worth waiting, to be honest. Let me just see one thing real quick. Yeah, because it could want to run up here. If I show you something like on the 15-minute, we could want to run up here before going back down. So I'll either wait for that or I'll wait for a close below this 1 minute fair value gap here. So, and because the event is done, I mean, it's hard to have experience with this if you haven't traded news before, but because the event is over, you can get a new run of liquidity before going to the draw, right? And we have all of this here. So gotta wait for a bit more confirmation. Do we have SMT with ES? I think so. Yes. Yeah, yay. Okay, let's see if we can push it now. Drop, drop, drop it like it's hot. Wait a minute. Where is that low? All right. Let's see what we can make out of this. I want to get to PM low, and I want to get to that low. But I might take it all at PM low. I'm up a lot. Keep going, baby. Get the nut. Ooh, ES is flushing too. Keep going. Up 1,300. We want 1,300, baby. Yes, yes. 1,500. $16. Just got to get past this order block here. I'll tell you what SMT is in a second. I'm going to book one here. All right. Booked one. And we're going to get the nut on the second one. Can a squirrel get a nut? No longer Tradeovate? I'm also using, I have this running on so many accounts. Let's get the nut. Here's my, I have this running on NinjaTrader too. So I have like 5 funded accounts and a couple of new evals. Guys, we're going to get the nut. I think we're going to get it. Nut! That's how you do it. That is how you do it. How many of you caught this with me? Because you know what? It should have been, put a W in the chat if you caught it. Let me see the W's in the chat if you caught it. Hell yeah. Yes, yes, yes. Let's do a trade review, guys. Let's do a trade review because we're not just about alerts, we're about education. Fuck yeah, what a day. Oh shit, I forgot to close this on my NinjaTrader. I gotta close this right now. Hold on. All right. Nice. All right, trade review time. Let me break down the trade for you because, like I said, I'm more concerned about you guys learning than I am about alerts. Even in the Discord, I'm more concerned about you guys learning, not alerts, right? When someone says, "Oh, I want to join," how many alerts do you do? I'm like, bro, the Discord is not for you because I'm going to turn you into a boss trader. I'm not. My job is not to give you alerts. My job is to teach you how to trade. All right. So here's what I was looking at. Okay. If I pull out ES side by side so that I could show you what I'm looking at. Okay. This right here is the 5-minute chart. So it all starts with the high time frame. What did you guys hear me say on NQ? I said, I think the draw on liquidity is that low right there. And shout out to the mastermind students from Sunday, right? I told you, if you know how to draw a horizontal line, you know how to draw liquidity. And so when price is coming down, right, even though I missed most of the move, right? Most beginner traders are going to think, oh, I want to go long, right? This is down so much, I want to go long. That's what most beginner traders think. An experienced trader who understands liquidity is thinking, okay, there could be a long, sure, but not before we take liquidity. So where is that liquidity at? Okay, we have this low here from last Friday. We could obviously keep going down to this low, right? But the most immediate low was here. So as we're coming down in there, your next job is, do I have a trade to get there? So I'm looking at this here, right? And I was looking to see if there was a fair value gap of some sort. So when I looked on the 3-minute, there was a fair value gap. But you guys recall, wait, was it the 3-minute or the 2-minute? Sorry, the 2-minute. There was a fair value gap, right? And I entered this numerous times. Could have took profit, but I kept getting stopped out at break even. Then when Powell was finally done, what did I say? I said there's usually a little run on liquidity after the event is over. Now, there's no way that you would know that unless you've traded events before, okay? So we ran the liquidity, which was our original entry. You can see here the spike here. Then I said, okay, we ran the liquidity. Now I want to see if there's divergence. That's what the word SMT means. It's divergence between NQ and ES since they're related pairs, right? And typically one runs liquidity, the other might get front ran, okay? So because they're both trading off algorithms. So if you see here, on the right is NQ, made a lower high. On the left is ES, made a higher high. That right there is called SMT, divergence. It's basically one makes a higher high, one makes a lower high. So we got the SMT divergence, and NQ swept this little internal high here after Jerome Powell walked off stage. So then, oh, you can't see because of my camera? 1 second. Good point. Sorry. There's the lower high and there's the higher high, right? We swept this tiny internal liquidity here after Jerome Powell walked off stage and created this SMT. So if you guys were on stream, what did I say? I said, I want to see one of two things. I want to see either an IFVG created, inverse fair value gap created, right? Or if it's going to trade higher, I want to see it trade higher into, I had some imbalance up here off the 15-minute or something, right? You have this huge 15-minute fair value gap. So I said either it's going to drop from here, and I'll know that because it creates an IFVG, or it's going to engineer more liquidity higher before dropping. Once it created this IFVG, then we close below it. You can either take the short the minute that it closes below it, or you can wait for a retracement back up. Either way, it was right around the same level, a few ticks difference. So I took the short with you guys on stream, and my target was the low of the day because that gave me 2-to-1. The ultimate target was that low that I was telling you guys from Thursday. But I didn't really need to get all the way down there because the 2-to-1 gave me right here. So always take the low-hanging fruit, especially on a day that I got stopped for break even 3 times. You guys saw it on live, right? I entered, break even, entered, break even, entered, break even. So the 4th time I'm like, okay, let me not go for like an ultimate TP if I can get the 2-to-1 at a very low-hanging fruit level. So does that make sense? And by the way, we teach all of this in the mastermind, and the mastermind 10.0 is going on right now. Those of you who are in the Discord, I gave you guys a fat discount to the mastermind, and I'll continue to do that if you're a part of the Discord. But yeah, mastermind 10.0 is going on right now. We just had our first session on Sunday. So if you want to join and you want to trade live with me every day, link is in the description below. And then once you're part of the Discord, ask me for a discount on the mastermind. I'll give it to you. But any questions from that? Is there a free trial? No. We're too valuable to have a free trial, man. And I make a ton of videos anyway. I give out a ton of free content, guys. So no, I'm not doing a free trial. We're too valuable, and we don't want, if I do a free trial, we're gonna have thousands of people in there, and it's just gonna muddy up the conversation and really muddy up the experience for people who want to take it seriously. I'm just 100% being honest. I've been running it since 2018. I could tell you from firsthand experience. It makes it unpleasant for all those that are actually there to learn, right? And also you get a bunch of trolls and whatnot. So unfortunately, we're not doing a free trial. We already have a ton of people. What's the mastermind? Are you in the Discord? If you're in the Discord, hit me up. If you're not in the Discord, you can sign up for the mastermind for sure. It's just at whatever the full, let me see what my team set it at right now. I don't even look at this shit. Where is it? So just being honest with you, right now it's set. It's a lifetime membership, right? It's set at $3,500 basically, $34.97 lifetime. You get access to all the masterminds, access to the Discord for life. It's a great deal, but if you're part of the Discord, I gave out I gave out $1,000 discount in the Discord for any member in the Discord. So if you wanted to join it, I would suggest joining the Discord, and then I'll give you the discount code, and then you can cancel your monthly because it's a lifetime. Any questions? Soxel's on its knees. Man, that Soxel, if you can get it for less than $5, to me, that's like buy 1,000 shares and hold it and don't open it until next year. Because Soxel at 1,000, if you just buy however many you want, but right, like Soxel's high was $70. And I think that depending on your portfolio budget and your portfolio size, there could be room for Soxel in there and not that much money. And I think in a year or 2 years time, when that thing gets back up, it's going to be awesome. I'm really considering joining the Discord. I want to learn and understand and stuff. Also think it would be better to make $200 a week than working 20 extra hours. Yeah. Everybody wants to just tag me on Discord, Rapal. If you're on Discord, just at my name and tag me. Everybody wants to trade full time, obviously, right? And they want to quit their job and whatever. But honestly, the real flex in the beginning is being able to generate a side income for you, for your family, whatever, right? That's the first step. The first step isn't I want to quit my job. The first step is I have a good job, and thank God for that. But I want to make an extra $500 a month. I want to make an extra $1,000 a month, right? Pretty soon that's going to be $500 a day, which is an additional six-figure job. $500 a day is $125,000 a year. That's wild. That's wild, right? You don't need that much. Like I just had over $2,000 trade that took me a few minutes, and you don't even need that. But I would say, like, obviously, if you're strapped, no, I don't want anybody putting a strain on themselves to join the Discord. To be honest, but yeah, like, it's not gonna make me feel good. Do you expect a small pullback for tomorrow or next week? Bro, we're down 3%. What do you mean a small pullback? Almost 4%. What do you mean a small pullback? All right. One thing that we didn't talk about here is long term. Well, we kind of did, but if you watched my video from from Sunday, I showed you guys the moving average crossover between the 50 and the 200, the death cross. We are getting that now. Now, I admittedly, and we could still get there, but admittedly, I really wanted this. I really wanted to trade up here and take it short from here, because if we pull up the 300-day, it's right there. So we have the 300-day, the volume imbalance, the liberation day gap. So I would have loved to just trade up here, fill the liberation day gap into this volume imbalance at the 300 moving average and take it short. But we ended up going short before that. Either way, the death cross right here, not good. Not good. It doesn't, by the way, a death cross doesn't mean the minute that it pops up, we start tanking. If you look at the last death cross from 2022, which was a horrendous bear market, right? You see here the death cross? The death crossed, and it was the interim bottom. So I remember this, actually. We got a death cross, and, you know, some people were calling it out. I don't even remember if I called it out back then. And then, you know, some people said, oh, there's death cross. And then the market kept rallying. And everyone was like, haha, you fucking idiots with the death cross thing. Like, we're going back to all-time high. And then, woof. So I would love if we can trade back up to this level here, 550-ish. But if you're on the Discord, I'll definitely send out any shorts that I take. PayPal looks super juicy. Let's see. What did JP have to say? It doesn't matter. Same blah, blah, blah bullshit. I don't think PayPal looks good, no. I have to disagree here. I think PayPal can go lower. I think a lot of things might revisit October 2023 levels, if I'm being honest. Yeah, Nvidia dropped to $100.45. But once SOXX, if we hit that 144 level again, I'm going to take, well, if we hit a 144 level again, I'll start a position in SOXL. And honestly, like, I don't know that we hit October 2022 level, but we sure have a lot of fucking support here. Either way, 144, I'll start a position in SOXL. Here, I'm just buying thousands of shares because at that point, SOXL will be in the low single digits. And it's what is a couple $1,000s? Before I get this lifetime, how's your health? You've been hitting the gym? I've been hitting your mom, bro. You tell me. Is that healthy? We have 2 other full-time analysts, too. It's not just me babbling in your ear all day. You had $20 on your 50 count Apex, and I hit DD trying to hit the $20. Wait, you had $20 to pass your 50K account, and you blew it? Yeah, there's no excuse for that. Not for blowing an account. You can blow an eval, whatever. But if you're $20 away and you go from being $20 away to blowing the account, yeah, there's no excuse for that. Just like when, who was it? It was Steven Jackson and Matt Barnes asked Kobe, have you ever airballed a free throw? And he said no. He said there's no excuse for airballing a free throw because I think LeBron had airballed many free throws in his career. So yeah, just like Kobe said, there's no excuse for airballing a free throw. There's no excuse for being $20 away from passing your account and blowing the account. You can just take one fucking micro. All right, guys. I appreciate you rocking with me. Glad we got that trade. Couple $1,000 on the books. I made a few of you richer, as always. But I appreciate you rocking with me. If you want to join the mastermind, I would say, honestly, just join the Discord and ask me for a discount. It'll be a lot cheaper. But I appreciate you. I'll see you guys on the next one. If you're in the Discord, I'll see you in the Discord. Peace.